All right, welcome to The Explainer. Today, we are diving into a 400-year-old idea that, and I mean this, completely changed the world, the stock market. We're going to see how it all kicked off with something as simple as spices and ended up with trades moving at literally the speed of light. Let's jump in. So everything starts with what seems like an impossible problem. Just picture this. It's the early 1600s. You need to fund a ship to sail to the absolute edge of the known world, facing down pirates, killer storms, disease, you name it. It costs an insane amount of money, and you might not see a penny back for years, if you see it back at all. So where on earth does that kind of cash come from? Well, the answer to that problem was an idea so powerful it would go on to reshape global trade, bankroll the rise of entire nations, and pretty much build a foundation for the economy we all live in today. And here it is, the big breakthrough. In 1602, the Dutch East India Company, or the VOC, had this totally revolutionary idea. Instead of trying to find one super rich person to back their dangerous voyages, they thought, hey, what if we sell tiny little pieces of the company to anyone who wants to invest? This spread out the massive risk and, for the first time, gave ordinary people a shot at the potential profits. This was it, the birth of the first publicly traded company. Now, this was a huge leap in thinking. You have to understand, people weren't just funding a single trip anymore. No, they were buying a piece of the company itself, a permanent organization that would exist long after any one ship or crew was gone. For the very first time, ownership was truly separate from the day-to-day management. And that shift, from a one-off gamble to a long-term investment, became the actual DNA of modern financial capitalism. As you can imagine, this idea was a total game changer, and it spread like wildfire. Formal exchanges started popping up to make trading these new shares easier. It all kicked off in Amsterdam in 1602 with the VOC, but pretty soon the model was copied in other major financial hubs. By 1792, the seeds were planted in America with something called the Buttonwood Agreement, which eventually grew into the New York Stock Exchange. And by 1801, the London Stock Exchange was officially up and running, creating the organized markets that would pour money into the Industrial Revolution and everything that came after. But, of course, whenever you create a powerful new way to make money, you also introduce a timeless, very human problem. Greed, fear, hype, our emotions. They can take over, and when they do, things can get absolutely chaotic. The first big lesson didn't even come from stocks. It came from flowers. Yep, flowers. In Holland, people started speculating on rare tulip bulbs, and it got so intense that prices went to just insane levels. We're talking a single bulb costing more than a mansion. And when that bubble inevitably popped, fortunes were just gone. It was the classic first example of prices completely detaching from any sense of reality. Okay, so fast forward about a century, and a much more relevant crisis hits the stock market directly. The South Sea Company in London, its stock price soared based on nothing but wild promises and a ton of insider dealing. The crash was catastrophic, and it taught a really painful but really important lesson. Markets can't just be a free-for-all. If you don't have rules and trust, the entire system just collapses. But here's the thing about lessons from the past. They're really easy to forget. And in the 20th century, the world was about to learn that exact same lesson all over again. Only this time, the scale was truly global and absolutely devastating. By the late 1920s, the U.S. stock market was basically a giant party fueled by easy, borrowed money. But under all that excitement, the real economy was actually pretty weak. So when the bubble finally burst in 1929, the crash didn't just wipe out fortunes, it shattered confidence completely and kicked off the Great Depression, throwing the entire world into a decade of economic pain. The sheer devastation of the crash made one thing brutally clear. The system was broken. It had to change. You couldn't just let the markets police themselves. So, in response, the U.S. government created the Securities and Exchange Commission, the SEC, back in 1934. Its whole job was to be the referee, to protect investors and make sure the markets were playing fair and being transparent. And this table really shows you the night and day difference. Before the SEC, you had markets that were basically regulating themselves. Financial info was murky at best, and fraud was just common. After the SEC, you get a huge shift to mandatory federal rules, strict reporting for companies, and real enforcement against manipulation. The goal was never to get rid of risk. You can't do that. But it was to build a foundation of trust. Without that, a healthy market just can't exist. Okay, let's jump forward to today. The fundamental challenges, trust and transparency, they're still here.
But now they are compounded by something the early pioneers of the market could never, ever have dreamed of: the speed of light.
So, welcome to the world of high-frequency trading, or HFT. This is where supercomputers running incredibly complex algorithms make buy and sell decisions based on tiny, tiny market moves, and they execute those trades at speeds that are just physically impossible for any human being. So just how fast are we talking? Well, some of these HFT algorithms can execute a trade in a single microsecond. Let that sink in. That's 1/1,000,000th of a second. This isn't just a little bit faster, it's a completely different reality for how markets actually work.
And this incredible speed creates a brand new problem. Let's say you're a big pension fund and you need to sell, 500,000 shares of some stock. The HFT algorithms will see your order coming, and the price will move against you before you can even blink. So what do? You go somewhere the algorithms can't see you. You go into a dark pool.
And this creates the central tug-of-war in today's markets. On one side, you've got the lit public exchanges, like the New York Stock Exchange. They're transparent, and they help everyone figure out what a stock is actually worth. But on the other side, you have these private, dark pools, which give big players the anonymity and efficiency they need. It's this constant battle between transparency for all and stealth for the few. So this constant push for a technological edge, this race to be faster and smarter, it brings us full circle. Just like in the past, all this innovation is creating incredible new opportunities. But it's also opening up new frontiers with risks that are totally unforeseen and often completely unregulated. I mean, the investment universe has just exploded. It is so much more than just stocks and bonds now. We have this huge mosaic of different assets. And the newest, most volatile, and let's be honest, most argued about piece of that puzzle is, without a doubt, digital assets, cryptocurrencies. So, at the end of the day, the fundamental story hasn't really changed in 400 years. It doesn't matter if it's the VOC selling paper shares for a spice voyage or crypto tokens trading on a global blockchain. The cycle is always the same. Financial innovation creates a new market. That market often leads to a wild period of speculation and instability, which eventually and inevitably forces some kind of regulatory response. Which leaves us with one final and, I think, critical question. With these new digital assets operating totally outside the traditional regulated systems, are we just watching history repeat itself all over again? Is the next massive bubble and the painful crash that always follows simply a matter of when, not if? It's a question that's going to define the next chapter in this incredible 400-year-old story.